Thank you for joining us. Today, we're excited to bring you a brand new show from the Onramp Media umbrella. Wake Up Call is a weekly show that will be streamed live on LinkedIn every Monday morning. To catch the premiere of each episode, follow Onramp's LinkedIn page and add Wake Up Call events to your calendar. After the live premiere on LinkedIn, we will distribute each episode across Onramp Media's podcast channels and YouTube page. Wake Up Call aims to educate financial professionals on the merits of the Bitcoin investment thesis, how this asset represents both a threat to legacy financial service businesses and an opportunity to differentiate oneself and retain and attract new clients. Hosted by Mark Connors, Onramp's head of global macro strategy, and Rich Kerr, Onramp's president of managed wealth, this show seeks to provide financial professionals the wake-up call they need, prompt them to have an open mind with respect to Bitcoin, rethink their prior assumptions, become more educated on the topic, and learn from others who are already farther down this path. Mark and Rich bring a combined 60-plus years of experience across traditional markets and financial services, and will share their unique perspectives in how their peers and colleagues can approach the realm of Bitcoin. Wake Up Call will feature guests from various backgrounds and industries who will also share their own journeys to Bitcoin and how others can get up to speed. Now, time for the show.
Good morning, everybody. I think we're live. What a Monday morning to kind of come together here, Mark and Jackson. Maybe I'll just quickly kick off and introduce Jackson Mikalic, who is Onramp's national head of sales for our institutional clients, and also works pretty significantly on our strategy work at Onramp. And you know, one of the wonderful delights of having Jackson join us is he's talked to hundreds and if not thousands of Bitcoin investors or people that are interested in accessing Bitcoin as a store of value for their portfolios, and he's largely got his real thumb, his thumb on the pulse of what advisors are talking about, thinking about, but also ultra high net worth family offices, foundations, endowments, and otherwise. And so it's a real privilege to have you join Mark and I today, Jackson. So thank you for coming in. It should be an interesting conversation. Every Monday morning over the last month since we've launched this, we've had such interesting events over the weekend. And so, I guess maybe where we should start is kicking it over to Mark to talk a little bit about, what's going on in the markets broadly. And obviously you had quite a Twitter or an X Spaces event last night, kind of talking through some of these issues. And so maybe bring the rest of our audience up to speed on what you're seeing and some of your points of view, and maybe Jackson and I can kind of riff off of that.
Perfect. Well, thanks for that. And Rich and Jackson, thanks for joining us today. Yeah, it was quite the week. And I guess you have to start with Japan and the yen. Three things happened last week that reversed a years-long profitable trade by institutional investors. And that unwind of the trade had spillover effects. So what were the events? The three events were, on Wednesday, the Fed announcing more dovish rate talk, pulling September rate cuts back into the horizon. So now there's a potential for 2 cuts before the elections. Then you had the Bank of Japan do a 25% rate hike. Japan has been holding rate zero. They've been living in a deflationary environment where rates are virtually zero. They raised them 25 basis points. The fact that caused a problem is really the crux of the global issue, which we'll touch on. The third item was an economic release by the U.S. on jobs. Fewer jobs created, higher unemployment, which means recession might be imminent. The reason that's a big deal is because, when people don't have paychecks, they stop buying things. And that is going to give the Fed a lot of political room to cut rates. But what does it have to do with the yen? For 3 years, the yen has depreciated by almost 50% against the dollar. going from like 105 up to 160 plus. And then it reversed just last week. People would sell the yen and related assets at zero. So they would basically swap dollars that are paying 5% for yen that paid zero. Institutions can do this through a swap. They did it with much leverage. Won't go into the exact amount, but it's not 2 or 3 times, more like 10 times leverage plus. When the yen reversed because people were worried or uncertain about what a 25% rate hike meant, and that maybe the yen would stop its depreciation. Why was the yen depreciating? Because people want to be in higher rate currencies. And the US, for the past several years, had a higher rate currency. If that's going to change, this 3-year trade that was profitable, it reversed trillions of dollars, Rich, in a matter of hours, if not days. A few people got tapped on the shoulder, and that has knock-on effects. So I'll stop there and see if you guys have questions, if I explain that well enough about one of the bigger assets in the world, global currencies, dollars and yen, had a major multi-year reversal last week because of 3 separate events, quasi-related but separate.
Wow. Yeah, I mean, where do we go with that, Mark? Holy cow! I mean, it's a fascinating period of time, and we're watching. All of the markets are responding. Now and watching what's going on in the United States, and so obviously these are you know percentage drops, right? But you also have the psyche that gets affected during these periods of time, and I think that the thing that really sticks out to me, and the reason why we're here is to talk and educate around Bitcoin. And you look at what's happening in the world today, whether it be geopolitical or potential kinetic wars in Iran, Israel, what's going on over in Russia and Ukraine, and you name it, right? So you've got a lot of people that are feeling, I guess, a degree of emotional stress, from what's going on in the broader political scenes. But you also now have, the unwind of the Japanese carry trade to an extent that's causing some pressure in the marketplaces, and so ultimately this weighs on people. And what I find most interesting is how does Bitcoin fit into this? Obviously, Bitcoin has retraced as well, right? I mean, this morning, I think when I woke up, Bitcoin was trading at around 50,000. Right now, it's about 54, so it's demonstrating quite a bit of volatility, but bouncing back off of the lows. And so the question I have is, what's changed for Bitcoin? And in my mind, not a whole lot, right? The thesis for Bitcoin actually is bolstered during periods of time like this, right? Because the monetary policy of Bitcoin is such that it is very transparent, it's understandable, it's immutable, and ultimately people, will be drawn to assets like Bitcoin that show, I think what I would consider, tremendous character in its monetary policy. And part of the problem of why we are where we are today is some of the currency manipulation and things on that nature from central planning. And so, in my mind, the Bitcoin thesis is well in place. And the other piece around what I was thinking about in reaction to market sell-offs is behavioral finance. I spend a lot of time thinking about, one of the beautiful attributes of Bitcoin is Bitcoiners develop a low time preference. They recognize that it's important to have that long-term perspective. And, largely, I kind of laughed this morning, but if you were to look at, Onramp employee banter, everybody's looking to, scrape up dollars and buy Bitcoin during these periods of time. And that, from an investor behavior standpoint, is the right thinking, when the market gives you these opportunities.
It is, and you'll hear that, like you hear people say that, and you're like, that's silly. It's like, no, because, as you said, Bitcoin's printed every 10 minutes. It was open when other markets were closed. It's like an animal that doesn't hold stress, but it just releases it immediately. And it works it through the system. Versus what the yen and dollar do is they hold on to it and they press and they press and they press until something pops. They try to suppress market dynamics through a centrally planned dynamic. And that's what we've grown and known all our lives. So we don't think anything of it, except when you look at some of the results of that behavior, like a deficit. We've had, bull run in equities. We've had low unemployment. How did we get it? Because everyone's hunky-dory? No, we got it because we've been spending more money than we have in a bull run. And so much so that, I'll say this until, as they say, the beatings will continue until morale improves, until people come back and say otherwise. Why Jerome Powell got on 60 Minutes in a non-emergency time period to say, we're in an unsustainable path, fiscally unsustainable, Congress and Treasury. And he pointed the finger because he sees it and he knows what the next answer is, and that's more printing, which is going to cause assets to go higher. And it's not very good for wage earners. So to your point about when we're talking about the central planning of the U.S. and about Bitcoin, yeah, I understand now that Bitcoin sort of works out all of the weak hands or uncertainty in real time so that you don't have to live a moment a month later, like what the Japanese equity holders are doing now. The chances of the top picks of the Nikkei to go higher, in the next couple of days, probably not that great.
Yeah, Mark, I have some thoughts on that as well. Certainly, I think the three of us agree that the thesis for Bitcoin remains unchanged, and the environment that we are in today, and the global macro lens that you've brought to the conversation today, Mark, reminds me of March of 2020. And at that time, I was sitting on a due diligence desk. So we would review, me specifically, I was on the alternatives desk, and we would diligence hedge fund managers and then private asset managers. So private equity, credit, real estate, etc. And naturally, on the hedge fund side, they're trading in public markets. They're trading very liquid securities and instruments. And in March in 2020, all hell was breaking loose. There was the treasury market dysfunction, equities. I think the S&P 500 was down about 20%, I believe, in that first quarter of 2020. And most of that happened in a matter of a couple of days or a week toward the end of the quarter. And this really reminds me of that period in the sense that we all understand how interconnected markets are globally, and the remedy, or not even the remedy, rather the approach to resolving the issues here, given that the interconnectedness of the global markets, it really drives across the board, meaning there's no way to fix the issue of what's happening overseas without it impacting the global financial markets. So I feel like right now we're in a period of mass panic and uncertainty, but you can kind of see the writing on the wall, similar to March 2020, where if you look out just a couple of days, weeks, or months ahead, it seems that there's going to be pretty considerable easing of fiscal policy, monetary policy, and ultimately the conclusion that I came to in 2020 and how I got to this place that I'm at today now, 4 years later, is that I really do think that all assets, whether it's equities, Bitcoin, real estate, what have you, I think that they are driven largely by liquidity. And the levers are fiscal and monetary policy. There was a world 20 or 30 years ago where value investing played a massive role, right? Fundamentals were incredibly important in selecting specific securities and outperforming your peers. But now it seems that while that still does play a role, and there's still an importance to that type of investing, really the macro and the liquidity landscape, whether it's contracting or expanding, seems to play an only greater and greater role in markets today. So that's all to say that in 2020, when we saw Bitcoin crashing from, I think it was $8,000 or $9,000 to almost $3,000, that was a fantastic time to buy, because what ended up happening was the liquidity bazooka, was brought out. We saw rates get slashed to 0% globally. We saw trillions of dollars enter the market. We saw a global coordination of easing, and Bitcoin ended up providing the safe haven against that currency debasement and ensuing inflation that showed up in the official government metrics only months and years later. So now I feel like 4 years from that event, we're kind of living in similar times where it feels very uncertain today, but we ultimately know that there's kind of, the lever only goes two ways, right? It's either liquidity is expanding or it's contracting. And I think we're getting close to the conclusion of the contraction period and entering a global liquidity expansion.
Yep. And Jackson, I'm looking at my at our note that we put out this morning to clients, and when you talked about that 8,000-9,000 down to 3, our deficit was less than 5%. So we gone through COVID. Phew, it's over. Our deficit went from being potentially 1.6 trillion in June to now over 2 trillion per the CBO, the Congressional Budget Office. So now we're, it's up almost 50%, 40% since that time. So the case for Bitcoin about being outside the system, immutable, and as Rich, you were saying, not centrally planned, is absolutely being validated for two reasons. And we'll be clear in this, and then we'll go on to what we really want to do here is talk about what clients are doing and how they're reacting to it, as opposed to just us talking about the current events and why the Bitcoin thesis is there. There's a problem in traditional finance, and it's terminal. As Lynn Alden says, you can't stop this train. We have jumped the fiscal shark as far as more debt is going to be needed to satisfy the increased interest expense as growth slows. That's the thesis. We have links to it. We'll let you read about it later for more support. Bitcoin's a remedy because it is outside the system. It doesn't let folks, political players, mess with the supply in order to deal with, as Rich said, people who have long time preference, meaning can't deal with pain and just need to get over the hump at any cost by issuing trillions of dollars, like we saw in March of 23 and like we saw in COVID. Bitcoin doesn't do that. That's why there's a good chance Bitcoin might end up above 60,000 today by the end of the day, because it is outside the system. So that's the crux of it, in my opinion, you guys. But the reason we have three of us here is because one guy always misses something. So as we lay out one of the bigger moves in the Nikkei ever, down 12.5% on Monday, and 10% decline in NASDAQ, have we positioned the problem of traditional finance and printing and debt and the remedy of Bitcoin well enough? Or is there anything else you guys want to bring in before we go into the meat and potatoes of policy and clients?
Well, I'll kick it over to Jackson. You got any thoughts there?
Mark, I think you hit the nail on the head in terms of just the environment that we're in today. I think it does tie into maybe now behavioral finance trends, right? And how do people think about what's happening in Bitcoin, but also the broader markets today? And really what I'm reminded of is, if we take a look back, Bitcoin is drawn down about 20% in the past week, right? So it's a pretty considerable correction. I think we've already talked a bit about why that's happened from the global macro lens, and the fact that Bitcoin is traded 24/7 around the world. There's no there's no impediment to that protocol. There's no Bitcoin is not down. You can always access liquidity globally. So it does kind of act as for markets globally, it does act as a way to get liquidity, especially over the weekends when markets are closed. So we saw a pretty considerable drawdown Sunday into today. Maybe people shoring up some cash to deploy into other areas of the market, or maybe people just kind of want to be in cash and wait to see what happens. But what I think about as it relates to Bitcoin is it really isn't all that different. Investing in Bitcoin is not all that different than what people have done over the past 40 years, in the U.S. at least, where the S&P 500, especially in the past 20 to 30 years, as low-cost index funds have really proliferated, but people have used equities as their de facto savings account, right? And
Yep.
What do your financial advisors tell you during times like this, when all the broad indices are down 3 or 4% today? There's a lot of uncertainty. There's concerns about geopolitical conflict. There's concerns about all the macro headwinds that we've just discussed. And if you call up your financial advisor today, I think a lot of them would tell their clients to stay invested, to not panic, sell out of the market. And really the same thesis or mindset needs to be applied to Bitcoin. It's not different in any way. If you're saving for your children's college education 20 years from now and you're using the S&P 500 to do so, you're not going to sell your position because the market is volatile in any given day or week, right? You're going to stay invested, and perhaps, if anything, you might add to your position if it makes sense with your financial plan. And I really do view Bitcoin as a very similar way to allocate my capital personally. And really, when we think about behavioral finance, there's just been over decades and over centuries, people have used different vehicles to preserve their wealth over time. And the S&P 500 was not the vehicle that people would choose to invest their life savings 100 years ago, right? The folks who came out of the Great Depression, they were typically using bonds, precious metals, maybe some real estate to preserve their wealth over time. And you have to what I see is there's an adaptation in investment vehicles that are available, and you need to be able to kind of change and skate to where the puck is headed. And that's where I see Bitcoin really playing a massive role going forward for advisors who are continuing to get more educated on this, and their clients are asking the right questions about it too. So I do kind of see there are similar lenses between the mindset that's been used in the traditional finance space, call it the last 40 years, and how I think Bitcoin kind of fits into that framework as well.
At Onramp, we believe that Bitcoin is the most important asset of the 21st century. The hard part is securing it right. There are shortcomings with keeping your coins on an exchange, but also with setting up your own self-custody arrangement. Onramp solves for these concerns. Our multi-institution custody solution maximizes security and minimizes counterparty risk, ensuring that your Bitcoin remains securely in your possession, and provides built-in inheritance planning to ensure your family is protected as well. Onramp provides peace of mind for your Bitcoin journey, whether for your whole stack or for part of it as a complement to your existing self-custody setup. For more information, check us out at onrampbitcoin.com.
Let's stay right there. So you said something kind of interesting right at the very end, Jackson, that struck me, which is, the questions that advisors are receiving from their own clients. And it's interesting to me whenever I'm speaking with an advisor, I always ask them what's top of mind for your client, right? And that's a general question, but if you ask it enough, and you go from firm to firm and you're talking to different companies, RIAs that you're meeting with, overwhelmingly, when I ask that question, what's top of mind with your clients, it is the impacts of inflation on their discretionary spending or their investable savings and things on that nature. And it's a pretty powerful pain point when you think about it, right? When somebody's saying, "Hey, look, what are the impacts of inflation against my financial plan, and am I going to be able to stay comfortably within my retirement years, blah, 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 whatever it might be, right? Or what are the implications to my savings in real terms, right? Because of inflation. The follow-up question obviously becomes, well, geez, what's the solution? What are you doing as a financial advisor that's helping the end client solve against the problem that's stated? And so I'm curious, in your conversations, you have even more conversations than I probably do on with the advisor community. I'm fascinated to hear, is that what you're finding in your conversations as well, or do you find something slightly different?
Yeah, Rich, I think those are great questions, and certainly the types of conversations that we see top of funnel. There are a lot of clients out there trying to understand how their portfolio will adapt to a changing, global macro regimen, right? Mark writes a lot about this. And how do people preserve their wealth over the coming 5, 10, or 20 years in a world where inflation is far above the 2% CPI metric, right? I know now it's getting closer to that level. There's a lot of nuance that we could talk about as it relates to that metric in particular, but I think what people really need to pay attention to is the rate at which the money supply is growing. And it's it's almost something that people don't fully pay attention to. We think of inflation, we think of CPI, but really since the 2008 financial crisis, and then even more so since 2020, asset prices are really a reflection now of how quickly the Federal Reserve and other central banks are growing their balance sheet. How quickly are they creating new money? And how quickly is that money entering the financial markets and inflating the value of asset prices? And one thing that advisors, ties into your question, that need to pay attention to and their clients are asking about is, how does a 60-40 portfolio actually preserve someone's wealth over the next decade? The answer is it won't, right? Because we're in a situation now where in the US, the debt to GDP is, and Mark could check me on it, I think it's about 120% or so. And really there's really only two options at this point as it relates to how do we handle that debt. It's either we either print more money and we'll use that printed currency to pay for that debt, or there will be some sort of default on the debt. And typically what happens is governments will print the money to pay for that debt, which means then, and this ties back into the question, which means that 40% bond allocation needs to be reassessed, because it's guaranteed now going forward that is going to be paying a negative real return. So how does someone who's 40, 50, 60, 70 years old think about their wealth over the next decade if it's 40% of it, plus or minus, is allocated to an investment that is losing purchasing power year over year? And this is where I think something like Bitcoin needs to be considered. Whether it's taken out of a sleeve of an equity portfolio or taken out of a bond portfolio, I really do think that the case is here now for advisors to be making small allocations across the board for most of their clients, and then depending on that individual client circumstance, maybe adding to that position. Because if you think about Bitcoin, what is it providing? It's providing a mechanism for growing purchasing power over time. It's a play on scarcity, namely digital scarcity, right? This is a digitally scarce commodity that cannot be altered in any way. And when all the currencies around the world are being manipulated in the sense of more and more are being created at a kind of an exponential rate going forward, you need something that is scarce, that can hedge your purchasing power over time. And then not only that, it kind of ties into what Mark mentioned earlier. Bitcoin, it doesn't have any sort of issue. There's no issuer to Bitcoin, right, that's centralized. So there's no government or corporation that stands behind it and stands ready to alter the monetary policy to meet the changing macro tides, right? This is something that's static. It's an inelastic supply. So the supply is already predetermined, and the demand, and it decreases every 4 years with the halving, right? But then the demand is really what's playing a large part in the Bitcoin price appreciation over time. And my final thought on this, Rich, is now we're starting to see the spigot open up for a lot of advisors that work at some of the larger firms. Just last week, Morgan Stanley announced that some of the Bitcoin ETFs in the US will be available now to advisors to solicit to their client if it meets their their investment suitability, right? So these are new. While the Bitcoin ETFs were launched back in January now, over 6 months ago, we're still only seeing the start of what I think is a very large secular wave of adoption of Bitcoin as an emerging asset class in the financial advisor space.
Yeah, no doubt. And if Morgan Stanley has just gone ahead and made that approval, inevitably you're going to see other wirehouses follow suit, and that obviously is going to be another driver for demand. Yeah, that's fascinating, and I love how you touched on the scarcity, and the known scheduled inflation rate of Bitcoin, right? With the supply that comes into it, and I think that that's a really, really valuable thought for all advisors to be thinking about, and that's the monetary policy in many respects, right? In action, and so when you look at some of the challenges that we're all talking about, if you distill them down to base factor, it all comes down to central planning and all of the manipulation that happens in various currencies that cause some of the pain and troubles that we've seen. And that was one of the most profound pieces in my Bitcoin journey, to be perfectly honest, is when I was reading the Bitcoin Standard and Saifedean Ammous was talking about looking back at historical records, right? Going all the way back into, the early 1900s and prior to the problems of the Great Depression. I mean, I thought, oh my gosh, he really kind of nailed it. It was all brought on by central planning and the course of action that central planners have taken. So, in many respects, we cause our own pain, so the fact that Bitcoin doesn't have an issuer, doesn't have a CEO, doesn't have a management team, it has a set schedule, a set supply schedule that decreases over a period of time is pretty phenomenal, and it takes that human instinct out of the play. That's a good call out.
So, focused on clients, because we all three obviously are the converted. We understand Bitcoin. We know its purpose in a portfolio. I'm not going to speak for everyone on the call, but I own Bitcoin, and Jackson, when you talked about the 60-40, and I have an opinion on this, and we've talked a little bit about this. How many advisors know the conclusion that we've drawn from our assessment that adding a little bit of Bitcoin during any rolling 4-year period has added to return absolutely and reduced not just risk-adjusted returns as measured by Sharpe and Sortino, but also has reduced downside volatility? I know it's a nuance, but I've shown it to you. Is that message out there? Appreciated, understood?
Mark, I think we have our work cut out for us. I think that message, and I think that message is not well understood at this point across the board. I think a lot of advisors are still trying to grapple with what is Bitcoin, and the challenge with it, right, is that it's we haven't seen anything like it before as a technology or an asset class. So it really does become challenging to describe that and find the right way to characterize Bitcoin, because it could be done several different ways. So Mark, I think a lot of people are even at the very top of the funnel as it relates to their understanding of Bitcoin. And what I'm finding now is a lot of these conversations are driven by the end clients. So clients are going to their advisors.
Got it.
Rather than the advisors going to their clients. The clients are asking the questions and saying, they're paying attention to Bitcoin some way or another. Some of them own it already. I mean, we talk to advisors where some of their clients have very sizable allocations to Bitcoin already, and they may already be doing self-custody, or maybe they have it on Coinbase account. And now advisors are trying to grapple with, how does Bitcoin fit into my financial planning? How does it fit into portfolio construction? How do I take these assets that live outside of my purview, and how do I incorporate them into the rest of the assets that my clients own? So these are some of the questions and considerations that advisors have today. And I think, at least from what I've seen, is it's A, a lot client driven, and B, there tends to be some sort of known Bitcoin expert, if you will, within a lot of these firms, that advisors that are less educated on the topic or still coming up the curve know that there's one person within their company who knows it very well, and that person becomes the de facto resource for the firm as it relates to thinking about the strategy. And quite frankly, those people end up being an advocate for Bitcoin and for Onramp in a lot of ways, because they start to understand our products and our solutions, and then they want to help their firm adopt a strategy as it relates to Bitcoin. And how do they actually have product offer to their clients that don't introduce some of these other risks that we're aware of as it relates to some other products, one being the ETFs in the US.
So Jackson, as you know, I was head of research at a digital asset manager in Canada, 3IQ, prior to joining Onramp. And the founder there, Fred Pai, punched through with his team the first spot Bitcoin fund in North America. And, for various reasons, people want to have spot funds better performing than the futures. But the story, I joined there in 22, and the firm started that product in 2020. But in speaking with clients that I got to know there, I'd go in, and the first people we'd meet were your age, not my age, because they were the first people in 20 to be like, I think I understand this. And they got their small clients. They were almost the people who made the cold calls in the firms. They were they were the dung beetles. They were low in the food chain, but they understood it, and they got people in, and they ended up being higher in the firm by the time I started talking to them in 2020, 22, and 24, because they understood it and they got their folks in. So this is a great way, at least if history is past its prologue, for an advisor to make an improvement for their clients and their own status and ranking within the firm.
I totally agree, Mark. I think kind of ties into what we talked about a little earlier on this call as it relates to just kind of generational thinking for wealth preservation. There's no rule of thumb as it relates to investing one's savings over hundreds or thousands of years, right? Like, these things are emergent, they change, they adapt, they evolve over time. And I think where advisors should be paying attention to Bitcoin is twofold. They should pay attention to it to the extent that it can help some of their older clients actually retire comfortably and maintain purchasing power over the next 1, 2, 3 decades, because we just talked about the problem that exists in fixed income markets. And then 2, there's a huge opportunity for them to be educated and ahead of the curve as it relates to their younger clients, because people who are more my age, millennials, by volume, not necessarily by dollar amount, but by volume, buy a crazy more amount of Bitcoin than Gen X or boomers, right? Like, in terms of volume of purchases, millennials and Gen Z are much more Bitcoin and crypto native people. So to the effect that, I know the average age of an advisor is about 55 or so, a lot of them think about succession planning within the firm and positioning themselves for the next generation. The real area to win and the real area to preserve and grow a business is thinking about the next 20 years. And Bitcoin, for people my age, Bitcoin is going to play a very large role in people's thinking about savings and retirement and providing for family. So to the extent that firms can get educated on it now, it'll do them a great favor as they start to do succession planning, as they start to see their clients, some clients unfortunately starting to pass away, and their heirs who are younger maybe are more familiar and more interested in Bitcoin than their father or their mother. So I think that there is an opportunity now to get ahead of the curve, because, like I said, most of the conversations that are happening with advisors and clients are still pretty, they're still pretty more high level at the moment. Mm-hmm. So there's really an opportunity to get ahead and be a differentiator in the market these days.
Wow.
Got it. And as we're talking, like what Rich said about waking up at 50K Bitcoin, we're now approaching 55,000, and even though equity markets are off the bottom as well, the move is much greater. And I bring that up not to say rah rah, but to underscore the data and the stats that we've shown that Bitcoin's correlation by the end of last week to NASDAQ was zero on a 21-day basis. Zero, even though NASDAQ was off almost, I think, 8 or 9%, potentially 10 from its peak. And that its 63-day correlation was closer to 30%, still below a highly correlated market. And the other data that we have, just shows that its volatility is very different, the makeup. It has more upside than downside. If nothing else, we invite people in the advisor space to call us. Jackson, please set up a meeting with any of the three of us to go over what that means, because it's happening live and in color right now in 10-minute increments. It's behaving differently. Yes, it's down 20% from the peak. That hurts. But if you have it mixed in with your portfolio and you quarterly rebalance or just hold it, again, over any period of time, you have benefited by reallocating when Bitcoin is lower, taking some off when it's higher, over any quarterly or annual period, over any 4-year period since Bitcoin's been around. So since we have the lab in front of us unfolding, we thought it was worthwhile bringing that one back up. And as Jackson said, that's still kind of a story, Jackson, that maybe only a few of the ETF holders that you've highlighted through the filings have really realized.
Yeah, that's right. That'll be something to pay attention to as well as it relates to the 13F filings, because we are approaching 45 days after quarter end. So August 15th will be the big day to pay attention to, where all the institutional owners, institutional being $100 million or more, will have to have their 13F filed with the SEC. So that'll be something to pay attention to as it relates to ownership of the Bitcoin ETFs. The first quarter of this year, so as the first quarter of ETFs in the US, we saw 80% ownership by retail. And what I'm paying attention to now is I would like to see that number trend lower over time for many reasons. But if we see 80% maybe go to 78 or 75%, it'll be an indication to us that now institutional investors, after seeing 1 or 2 full quarters really of Bitcoin trading publicly with ETFs, after seeing some of their peers, right? Wisconsin, I think, is the 8th or 9th largest state pension making an allocation in the first quarter this year. We've had several conversations with endowments and foundations over 2024, and a lot of them are investing into Bitcoin and the broader space as well. So this will certainly be something to pay attention to, not only next week on the 15th, but on a go-forward basis to see how the ownership changes over time. Is this asset being more adopted by institutional investors quarter over quarter? And my gut instinct is yes, because a lot of times these institutional investors will start with a smaller allocation, and then they grow that over time if the conviction grows, right? And the thesis and the understanding grows with it. So we're really only at the start of the institutional adoption of Bitcoin. I think people have said now for at least 2 cycles, maybe 3 cycles, that the institutions are here. But clearly I would say that they're not even here yet, right? Like, we're only seeing the first inning as it relates to Bitcoin kind of emerging as an asset class within endowments, foundations, pensions, sovereign wealth funds. So it'll certainly be an exciting trend to follow, especially as we kind of get into the 6 to 12 months post-halving, which has typically been quite an exciting time in the Bitcoin space as it relates to price performance and the cyclicality of how the asset trades. So a lot of things to watch in the next, call it through the end of the year and into 2025 to pay attention to.
Standing. Hey, Jackson, that might be a great place for us to kind of close off. the wake up call this morning. I really, what struck me is you said 80% of the flows into the ETFs indicate being retail. And to me, I find that absolutely fascinating, right? That the general unadvised client is gravitating so strongly to Bitcoin. And if you think about the origins of Bitcoin, right, it was very grassroots. It was individuals that were finding their way to Bitcoin. They were developing their own thesis. They were thinking independently. They were applying critical thinking to the world around them, and they were recognizing a problem. This is why advisors need to be paying attention, in my opinion, because they have a very, very critical function of pulling all of the pieces of a financial plan together for people. And if they're not paying attention to where the mindset or the psyche of the individual investor is, that's a potential risk. And it's a tremendous opportunity to those firms that are embracing it. You touched on it, with the demographic piece that you just tied into it, right? Which is, you have a very large segment of society, right? That next generation, the millennials and the Gen Zs, and that need a different approach. They require and demand a different approach. And if you aren't speaking to that as an advisor, there's a real missed opportunity and a potential risk or a threat to your business. And so, look at Bitcoin, do the work, but recognize that it's speaking very loudly to the general population. And what's your role? Do you have a voice? Do you have a point of view and an opinion? Whatever it is, but that being said, our belief is that, this is a unique asset that has tremendous capabilities for any investor of any age. So that being said, Jackson, Mark, thank you both for the tremendous thoughts that you shared with our audience this morning. It was really insightful. Appreciate it. And Jackson, we look forward to having you back on the show. I mean, your insights are really, really tremendous in terms of where everybody is at and how they're viewing the assets. So thank you so much.
Thank you, Rich and Mark. Really appreciate the time.
You bet, gents.
Right.
Thanks. Take care.
Thanks for listening to this week's episode of the show. If you found the information valuable, please share the episode with a friend or leave a rating on your favorite podcast app. All the links we discussed in today's show will be in the show notes inside your podcast app. Before we finish, a quick reminder that Onramp Media is for informational and entertainment purposes only, and nothing should be construed as investment or legal advice. Regardless of where you are on your Bitcoin journey, we'd love to hear from you. Visit onrampbitcoin.com/contact to schedule a consultation with one of our private client advisors.